Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And today, instead of sharing another case study, I thought I'd answer more listener questions. And in fact, I think I might alternate between case study episodes and question and answer episodes. Hopefully you find the questions and hopefully answers as interesting as I have. Okay, so let's get into the first question. And it's from Lachlan and Ange. He says he'd like to thank me for the podcast. So you're very welcome. They say they live in a home in a great location with the house is worth about $2 million with about $550 home loan, and they have an investment property. It's worth about $900 with about $450 remaining on the loan. They're in their late 30s, early 40s with two young children. They go on to say they're financially stable and want to invest further to help their children down the track. However, interest rates are making it more difficult without a big change in standard of living, which they're not willing to make. During the refinance process, they just refinanced their loans. He was contacted by an agent in Brisbane asking if they're interested in selling their investment property. Comparable sales are around about $1 million. So I think he's thinking, well, it's worth, or it was valued, bank valued at $900, but maybe you could get $1 million. He said rough calculations post CGT and income tax would reduce our mortgage on our home loan below $200,000. So the intentions would be to clear non-tax deductible debt, save and position themselves to make additional investments when interest rates normalise. He goes on to say, my question is, would you break the golden rule of holding an investment property for 20 plus years and sell? Lachlan goes on, our gut feeling is telling us to keep the investment. It costs us approximately $150 a month to keep, and it will likely grow in the coming years. However, the thought of paying off our mortgage in our mid-40s is tempting and probably a short-sighted point of view. Interested in hearing your thoughts, and as you keep suggesting, professional advice is certainly on our to-do list. Well, thanks heaps for the question, Lachlan and Ange. It's a really good one. And just to recap, because I feel like I made that question a lot more long-winded than it probably needed to be, but Lachlan and Ange are thinking, do they go and sell their investment property to reduce their home loan, particularly while interest rates are a little bit higher, provide a little bit more headroom, or do they hang on to it? I answered this question indirectly in August last year. So episode 269, published on the 9th of August 2023. It was titled, What is the Priority, Repaying Your Home Loan or Investing? As I said, it was an indirect answer really, or indirectly applies to this question, I should say, because it was more around where should you direct cash flow. Anyway, in the podcast and the blog, I posed 3 questions that are good to reflect on in order to answer that. The first question is, do you have a sufficient financial buffer, or you're so highly geared that it's very risky? Question number 2 is, will you be able to reduce your debts significantly before you retire? Hopefully, in fact, get it to zero. And question 3, how sensitive is your cash flow to changes in interest rates? So it's really sort of comparing the commitment to your income. If it's eating out or sucking out a lot of your income, then you're going to be very sensitive. And I would use the same questions to answer this question in regards to whether they should sell the investment property or not. Ange and Lachlan say that their home loan's about $550. They don't tell me what their incomes are, but assuming they're relatively average incomes, then that relatively average home loan doesn't really concern me so much. If they said they had a $2 million home loan, then you start to think, okay, well, how are we going to be able to repay this? So even at 6%, so the investment property is $900, somewhere between $900 and $1 million. Let's assume that it grows, but it's not fantastic. Let's go 6% per annum over the next 20 years. If it's worth $900 today, in 20 years' time, it will be worth 2.9, maybe round it up, say $3 million. That's a circa $2 million of additional equity that they'll have in that investment property. If they go and sell that, they'll obviously pay some capital gains tax, about 25%. So they'll walk away with another $1.5 million in their pocket. Even if they hadn't repaid 1 cent against their home loan, they still owed $550 20 years from now. Of course, inflation kind of eats away at that balance, but they've almost tripled, the amount that their home loan is worth. So they sell the investment property in 20 years, you can repay your home loan 3 times over. So it's not hard to see that hanging on for the long run is the best way to go. If it was different, if they said that they were so highly geared, it was really stressing their cash flow, they couldn't afford to hang on to the investment property, those sorts of things, then you'd start to think, okay, we need to reduce debt here. But hanging on to the investment property in Ange and Lachlan's scenario is going to be the best way to go. That's why I talk about in the podcast borrowing to invest. In fact, just borrowing, if you like. Great servant, terrible master. So you always want to do it conservatively. You want to build in provisions for things to go wrong or for things not to necessarily work out as you hoped. So try and be as aggressive as possible with your borrowings, but not to the point where you're going to get yourself into trouble. Great question, however. Okay, next one is from Graham. I think I might just read this one out, otherwise I butcher it. Hi, Stuart. Love the podcast, which I listen to along with many others. Thanks very much, Graham. My wife and I retire in December by this year. I think that's meant to say we'll be retired by December this year. Between us, we have 1.6 to 1.3 million in super, which will fall into an income stream. So convert to pension. It's a reasonable amount, 2.95 million in total super. Now, Graham goes on to say we have an investment home in Brisbane valued at approximately 800 to 850. Rent is $610 a week. Our dilemma is maintaining the investment with all the costs and end up with, say, $20,000 a year to pay tax on, or sell the investment, pay CGT of around $100,000 and throw $700,000 into super between us. I'm thinking super would give us more income per year because you're drawing 4% of the balance, as opposed to the $20,000 they receive by retaining the investment property outside of an income tax-free scheme like super. Graham goes on to say, yes, the capital growth of the home is the consideration, but does a balanced risk in super give you more money with less issues, headaches, tax, and so on? Appreciate your thoughts. Good question, Graham. Of course, if the investment property generates about $20,000 of income, you're probably not going to pay any tax. I mean, if you pay any tax on the $20,000, it's going to be very negligible, maybe a couple of $100 at worst. So you'd say the $20,000 kind of income stream from the investment property is tax-free, but of course, you're going to have to pay capital gains tax in the future. I think when looking at super returns and assuming that you're sort of balanced or something more aggressive than balanced, I think it's reasonable to make some assumptions of, say, about 7% long-term returns. I mean, if you look at history, super returns are actually better than that over the long run, but, just to provide for potential volatility and downside and so forth, that's a good number, I think, to make assumptions on and analyze scenarios on. So really, if you sold the investment property, you could put $700,000 into super and you'd earn 7% over the long run, and that 7% would be after tax, like it's going to be tax-free. Whereas if you keep the property, you're going to have to pay up to 23.5% of the gain in capital gains tax, which is really half of the top marginal rate. And I worked out that if we assume that you continue to receive $20,000 a year, your property needs to generate an average capital growth rate over, say, the next 15 years of more than 6.5%, which is kind of the long-term median rate on the median house price in Brisbane. So it's not too bad. It could do that. Now, of course, that analysis assumes you're going to get the $20,000 of income after expenses each year. So it doesn't really provide for the risk of maintenance and hassle and vacancy and these sorts of things. And don't forget that compounding capital growth rate of 6.5% is the break-even rate. So if you're going to get less than 6.5%, you definitely then go and sell the investment property. I think I'd work out, how long have you owned it for? It sounds like you don't have a lot of debt against the asset, if any at all. So you probably owned it for a long period of time. The whole point of buying it many years ago, I imagine, was to supplement retirement savings. And, you can certainly do that. I think if it was an excellent asset that you thought had a very high probability of generating a capital growth rate in excess of 6.5% to compensate you for, the risk of hanging on to it, the hassle of hanging on to it, then I would keep it. However, if it's less than excellent in terms of quality of asset and location and so forth, I think I'd probably lean towards selling it just to simplify matters. As you said, you can take some of the cash and contribute it into super. Of course, the individual with 1.6 should only put an additional $300,000 into super, and then the rest can go into the other person's account. Just try and keep those account balances below 1.9 if possible. If you go over the 1.9 tax-free cap, not such a big deal really. You're still not going to pay too much tax inside super. super, but just something else to consider to sort of even that up. But thanks for the question, Graham. It's a really good one. Okay, so the next question is from Sean. Sean says, I love the podcast. I've been listening for ages now. Thanks so much, Sean. I'm keen to hear some more in-depth information about leveraging through equity from our primary place of residence. Sean mentions he'd like information on recommended ETFs, debt recycling options, growth options, maximum LVR into different ETFs, how long should your dollar cost average for, and so on and so forth. Sean goes on to provide some personal information just as context. He says, we're exploring this option as we have access to around 200,000 of equity. However, our cash flows won't allow us to loan enough to get a good investment property, and we would have to stretch ourselves to get something average, which we don't want to do. Good, Sean. I think that's a good decision. I've written over the years, sometimes we get quite blinkered to say, borrowing to invest, and then we just try and fit our strategy into our borrowing capacity as opposed to the reverse. And if you can't afford to go and buy a really good quality investment property, then think of other strategies. So, Sean, you're bang on there. Anyway, Sean goes on, we are looking at an absolute minimum of 15 years time horizon, investment time horizon, and want to keep contributing along the way, potentially further equity releases in the future, and planning on dollar cost averaging an additional $250 per week minimum to contribute towards the loan to value ratio. Strategies and tips around this, he goes on to say they have about 32,000 in ETFs already in VAS and VGS, which is Australian Vanguard International, and some NDQ, which is NASDAQ, the tech index in the US. So there's heaps in that question, of course, Sean. I mean, the first one I would talk about, ask for ETF recommendations and so forth. In fact, I just recorded a video on YouTube, which you can Google it or go to our YouTube channel to see it. I just did it in the last couple of weeks. The video is called, the subject line is an example of how I construct an ETF portfolio. So that's what it's called if you want to find that video, because people keep asking, how do you put a portfolio together? And I just wanted to give an example of that. But it is a very point in time thing. How I would construct an ETF portfolio today might be different to, in fact, will probably be different to how I might construct it in 6 months' time. So I'm reluctant to sort of say, okay, I think you should be putting 20% into this ETF and 10% into this ETF, because I don't want people to blindly follow that advice. It might not be appropriate to them and their individual circumstances, and it might be appropriate today in terms of accommodating market conditions, but if you're listening to this sometime later, maybe it won't be appropriate. That's why I sort of think you go into two camps. You either go diversified ETF, let the manager manage the asset allocation for you, or go and get some advice. But just be careful. If you get too tricky with it, if you mess it up, you can potentially ruin the investment strategy. Regarding borrowing to invest in shares, I think my warning would be just be really careful. I published a blog on the 30th of August 2021, so about 3 years ago now, and the blog is called A Powerful Share Market Investment Strategy. And what I did is I back tested, looking back and saying, well, if you had to invest in the Australian stock market since 2001, how would have it worked out if you did it on a monthly basis? And I have a chart in there that sort of shows you that, for example, if you started making regular monthly contributions in 2001, by 2008, you would actually just have your capital in that investment. You would have had no capital return. Now, of course, you would have picked up the dividends and the income from those investments. But if you had geared into that investment strategy on a monthly basis, you'd actually be in a loss position because of the interest. So Sean mentions he's got a 15-year time horizon, which is fantastic. And that's a very long-term time horizon, that the sort of time horizon you want when investing in the share market. But just realize that borrowing to invest magnifies your returns, magnifies positive returns and negative returns. So it's entirely possible that if you go and borrow $200,000 against the equity in your home and dump it in the market tomorrow, that in 7-8 years from now, you'll be worse off. You'll be in a loss position. Now, you have to ask yourself, and certainly you've got to friends with that, firstly, and then ask yourself in 7 years' time, if that happened, would you lose faith in the strategy and then go and sell it? Because it's easy to say you've got a 15-year time horizon, but do you have the discipline and fortitude to stick with an investment when it's not working, even though you know the strategy has evidence that it will work. And I say that because, it's easy said, not always easy done. And that's why I sort of worry a little bit about borrowing large lump sums and dumping into the share market. And so to add to that, I wrote another blog on the 21st of the 6th, 23, so almost 12 months ago. And that blog was called Borrowing Capacity Isn't Enough for an Investment Grade Property, ? So you can Google that blog. But essentially I did some more analysis, and it really sort of is appropriate to Sean's situation because the blog was aimed at, well, if you don't have enough borrowing capacity, go and buy an investment grade property, invest in the share market. And in that blog, I reached a couple of conclusions. Investing in a lump sum is better than investing monthly, just mathematically. If Sean could dump 200,000 in the share market today and it didn't crash over the next year or so, then in 20 years from now, he would be better off doing that than, say, investing $10,000 a month for the next 20 months. So sort of spreading your timing risk in there. The second learning from that blog, that I sort of shared looking over the data, was that investing a year or just prior to a crash is bad for investment returns no matter how long you hang on to the investment for. So the reason I mention those two observations is that when markets are trading at all-time highs, and they certainly are today, or at least when I'm recording this, and I'm sure they will be pretty close to all-time highs when you're listening to this recording, then to me, there's a lot of risk in the market. In that situation, you want to be conservative, invest on a monthly basis and drip feed it in. If the market was to crash and it dropped 40%, then Sean, I would say, yeah, go and borrow your 200,000 and dump it in the share market. You might not be better off in 2 years' time, but I'm almost certain you would be in 10 years' time. Again, easy, like with lots of things with investing, easy to say, really difficult to do because at the time of a 40% drop, there's not a lot of good news around. And there's certainly very few people that would say we've hit the bottom as well. No one rings a bell at the bottom of the market. So again, this can be really challenging. So look, when the market's really high, just be careful with leveraging. I guess that's what I'm sort of saying. Okay, the next question is from Peter, a bit of an easy one, really. Hi, Stuart. Well done on the Q&A podcast. You've managed to say something that's very good, upper level. Well done. Thanks so much, Peter. I wasn't sure how the Q&A would be received, but as I said many times, I'm enjoying the questions. I think they're really good. I hope you as listeners enjoy it as well. Okay, so Peter goes on, maybe a relatively narrow question, but I'll ask it anyway. What advice do you give people moving into pension phase in Australia when they move overseas, potentially permanently, or maybe just in the first years of retirement? What factors should they be considering? Well, Peter, good question. I don't think there's anything that you would really need to consider. If you're drawing a pension and you're spending most of your time overseas, as an Australian tax resident, that pension income's not going to be taxable. If you become a non-resident for tax purposes, again, that income's not going to be taxable. Some super funds might seek to withhold some withholding tax, but you should be able to get that back when you lodge an Australian tax return. I guess the only consideration you might want to address is if you became a tax resident in another jurisdiction. So if you ended up spending a lot of time in one particular location, and that triggered taxation residency, would there be any tax consequences associated with that? But otherwise, I can't really think of anything that I'd be really concerned about, particularly if you're just sort of traveling around. If that's what you're doing, then you're probably unlikely to be a tax resident anywhere else, and you're probably unlikely to lose your tax residency here in Australia as well. Okay, next question is from Vishal, which is another really good question. Hi, Stuart. Thanks for an amazing podcast series. Thanks so much. I'd like to know your opinion on the following portfolio building. I'm a professional with a good income in my early 40s. As a family, we do max out superannuation every year. Outside of super, we have our own principal place of residence and also a share portfolio consisting of only 2 ETFs. That is VESG, which is Vanguard International Ethical Fund, and then IWLD, which is an iShares Ethical Fund. iShares is BlackRock. BlackRock is the biggest fund manager in the world. Anyway, he goes on to say our goal is to have a well-diversified portfolio that is ESG compliant in AUD domicile. Our risk appetite is very high and we have no inclination towards bonds, commodities and property investment. So I should say ESG stands for environmental, social and governance. and really, let's just call it ethical investing, if you like. Stuart, we recently found out that VESG has been in the news for some greenwashing claims. It has been given a 3-star sustainability rating by Morningstar. Do we sell this ETF and put the money into IWLD or a completely new ETF? Is IWLD alone good enough as a core ETF for the long term? The challenge around ESG investing can be, one, not being too active. And when I say active, that you're not taking tilts. You could have the traditional market cap index, which, as I keep talking about, has a long history of generating good returns. If we stick close to that index in terms of exposures, that's what the key success factor is. If we start overlaying things like ethical filters and those sorts of things, what does that do to the actual portfolio? Do we end up skewing towards a particular sector, geographical location? Do we limit the number of holdings in the actual ETF? What implications does that have from an investment perspective, which is distinct from an ethical perspective? That's the first consideration. The second consideration is how robust is the ESG methodology? And in fact, I was having a conversation with another financial advisor the other week, in fact, where some of the filters, the extent to which the research delves down into the actions by some of these companies are pretty extraordinary. For example, there was a pharmaceutical company that donated money to women in need to help with contraception, I think abortion, those sorts of things. It wasn't their core business. It wasn't anything like that. They just donated money to a cause like that. And then would that get caught up, for example, they were running a portfolio for a church and the church didn't want to have anything to do with anything abortion related. So, to what extent do you filter these things out? There's a lot of subjectivity, or there's some subjectivity involved. And, there's lots of different measures out there. Some funds will say, we filter for this, or this is the way we do it, but there's no one generally accepted approach. So I think you've got to, if in this ESG world, you've got to, either really delve into the detail yourself or understand that, there could be some things that slip between the gaps. Anyway, when comparing two different ETFs or two different strategies, there's some really important considerations, because ultimately, what's the point of having two ETFs if they're giving you very similar exposures, right? You're just there's no point, in fact, and you might be giving rise to additional cost and complexity for no actual benefit. So when comparing two ETF products, you typically look at a couple things, three things really. The first one is the geographical and sector allocations in each product. So that is the geographical allocations, how much goes into the US market, into the Japanese market, into the UK market, so on and so forth. And then the sector allocations, so technology, financials, healthcare, and so on and so forth. If you've got two ETFs that are giving you the same geographical and sector allocations, then you've got to ask yourself, why would you hold those two ETFs? You should only just hold one of them, because they're not really giving you any different allocations. The next consideration of fees. An iShares product is about half the cost of Vanguard's product. Now, we're not talking about big numbers in terms of fees. Vanguard's only charging 0.18% in terms of fees. But again, it's something I consider. And then the depth of the product. So how many names does it hold? How many companies does it invest in? So Vanguard invests in about 1,500 companies and iShares about 700, both pretty well diversified. Like, that's some significant diversification. I had a quick look at the asset allocations, that is the geography and the sector allocations between iShares and Vanguard, and there's not a big difference there, I would say. So they're just from, I haven't looked in great detail, admittedly, but just from that analysis, when you compare those two ETFs, I can't see that one's doing anything that's significantly different than the other one. Of course, Vanguard, and it tends to be this way, Vanguard does have a lot more diversification, so more individual holdings, but I don't think, when you've got 700 versus 1,500, I don't think that's really changing your life very much. Anyway, Vishal goes on to say, secondly, is ETHI, which is a BetaShares ethical ETF, a good core ETF for the long term? I feel it is mostly concentrated with high-priced mega companies and is a fringe thematic ETF rather than a core ETF. It's true, ETHI does have more tech exposure, had more US exposure as a result. It only has 200 holdings too. So look, it's not a bad product, 200. We're not going to go out and buy 200 individual holdings, but one of the benefits of having ETF is that you get, with one trade, a huge number of, ownership. Your money is spread across a huge number of different companies. So I think the other two ETFs are better, and certainly the iShares one, the IWLD, is certainly cheaper again. So from a cost perspective, it's pretty attractive. If you're looking at sustainability ratings, we use Lonsec Research. I note that ESGI and GRNV, they're both VanEck products, are quite highly rated ESG wise. But they do have, and you'll see this in these portfolios, do have a very different exposure to the broad index. So there's a lot less US exposure. Remember, the US is the largest developed economy and large developed share market in the world, and different sector exposures. So I think if you compare, say, ESGI, which is VanEck International, to either Vanguard or iShares one, you'll be able to see what I mean then, that you start to become almost like an active investor because you're moving away from the index. Even with these other indexing strategies that I spoke about in previous weeks, like quality overlay, a value overlay, the key thing with these products is that whilst we are filtering out, overvalued companies, for example, in a value overlay, we're still not moving away too much from the overall index sector weightings or the overall geographical weightings. And that's a really important point to make. We're still getting close to the broad index in terms of exposures. We're just filtering out some of those other companies. Whereas with some of these ESG ETFs like ESGI, the VanEck one that I just spoke about, you are making big changes to the overall portfolio allocation. And that might be an ethical decision. That's something you want to do, but it's just something that you want to be mindful of. Lastly, Vishal asks about any recommendations for ESG compliant ETFs on the ASX for a global small cap or developing markets, which are really emerging markets. Well, you're probably never going to get an ESG product for emerging markets just because it's hard enough to get the reporting to have a normal product just on financial basis, let alone for, ethical filters. Could you imagine, what sort of reliable information are you going to get out of some Asian countries, for example, on ethical fronts? I think that's going to be really difficult. I don't know of one. I don't think any exists on the ASX, but I think it's a problematic sort of strategy. I think the same thing for small caps. Small caps, indexing in small caps has like a 50-50 proposition in terms of like 50% of active managers outperform the index. It's not as compelling as is in developed markets. And I think I've spoken about that previously. So no is the short answer there, but some really good ESG questions there. But I think, just comparing sector exposure, geographical exposures, fees, and the number of holdings in an ETF is a really great way to make sure that if you're going to add a new ETF to your portfolio, what is it doing differently in the portfolio? If it's just replicating something else that you've already got that exposure, then there's no point. Okay, last question today from Tristan. Hi, I've been loving your podcast since the start as well as your books. Thanks, Tristan. My question is about strategies to catch up on my wife's super. We make a $1,000 contribution each year to get the government co-contributions as well as spouse contributions. However, I don't think I understand contribution splitting and how it could help. Could you please explain this for us? So spouse contributions and co-contributions are really incentivized strategies for low-income earners to get more money into super. It's just a way for the government to try and incentivize people to do that, either through a co-contribution, so, getting some money from the government, or a tax deduction with spousal contributions. So that's really the strategy is, increasing your discretionary contributions. Contribution splitting doesn't really do that. We've all got caps that we can contribute up to, obviously $30,000 for concessional contributions for this financial year and beyond. And contribution splitting doesn't really change that. It just changes where those contributions land. So I can, for example, contribute $30,000 into my super this year, which I've already done a lot of that already, but I'll certainly be doing that myself. And that $30,000 will be taxed at 15%, so $4,500 I'll pay in tax. That means of those contributions this year, I will have $25,500 left over. Contribution splitting allows me to move those contributions that I've made this financial year into my spouse's account, or de facto, which means that I can then move $25,500 from my account into her account. And I can do that each year if I'd like to. And the aim of it is to try and even up balances. If my wife has a substantially lower balance than me, she doesn't, by the way, but if she did, I could keep moving my contributions essentially into her account, minus the 15% tax, every year until we had a perfect balance. Arguably, you could move half your contributions, if you had an even account, but she wasn't contributing, contributing, or it wasn't tax effective for her to do so, you could split 50% of your contributions this year into her account. So it doesn't really help you get more money into super from a family perspective. What it does do is tries to help you sort of even up super balances, which is really important because as one person gets ahead, so that a higher and higher balance, that differential compounds as well, because of compounding growth, that gap will continue to widen. So it's one thing, I mentioned this in an answer to a question in previous weeks. Don't leave it too late to try and even up balances. Contribution splitting can be a really good strategy. And you can do it at the end of the financial year. If you've got an industry fund or whatever it might be, it's just a complete one form, do the split. It's pretty easy. Okay, I'm conscious of time. That's enough for this week. Thanks for all your questions. As I said, they're really great questions. I'm going to try and keep getting through all of them as I promised. So just send them to me at questions@investopoly.com.au. And until tomorrow, bye for now.